Hello, Mark here from Success with Options. Today I wanted to quickly go through some basic calendar spread principles. Now in a prior video or series of videos I'd actually gone in fair amount of detail into the calendar spread, how it's made up, what are the various components, how to enter a trade, manage a trade, and exit a trade, and so forth. Today I wanted to go back and review some basic concepts and answer some questions that might still exist with respect to calendar spreads. So today what I want to cover is when to trade a calendar spread, what kind of climate, what would make us want to enter a calendar spread, how to pick strikes, calculating potential profit, and when to exit or roll. Now I want to start with the basic principle that a calendar spread is a positive vega position. That's important because it's different than a typical vertical spread that we've traded or an iron condor, which is a combination of vertical spreads. These positions are negative vega, which means that they decrease in profitability as volatility increases, whereas a calendar spread is positive vega. That means our position gains in value with an increase in volatility, and that's an important thing to consider. Now, in terms of when to trade a calendar spread, let's keep in mind that based on the fact that they are positive vega positions, they're ideal when volatility is low and we expect a rise in volatility. For example, if we take a look at our EWZ position, we can see that historically volatility has been a little bit higher, and right now volatility is lower. So might it be a good time to trade this position? Sure, because volatility is low and it could get lower, but it could also go higher, and that means that it could be a prime candidate for a calendar spread. Now, calendar spreads can be traded by themselves, meaning that they can be traded just for the sake of trading the calendar spread, or they can be traded to actually adjust or hedge another position. And we're going to talk about both of these in a little more detail. Now let's switch over to the trading platform and let's talk about the choosing of strikes. Since we've been looking at the EWZ position on the chart, I'm going to go ahead and set up that trade in the Trade tab. And we're going to look at a couple of different ways that we want to consider using to select our strike price. Now, one of the ways that we can select the strike price is based on the probability of expiring, meaning the probability of when that short strike is going to expire worthless. And I've got highlighted right now 29%. That would probably be about the bottom end. Using a strategy like this, we could say that our probability is somewhere between 29, 30, and 35. We could pick a range, whatever we feel comfortable. We could actually pick a range between 24 and 30 or anything like that. The trading plan is going to define what range of percentages of probability we want to go with. I would say that the further out of the money we choose, the more we expect that stock, the underlying, to move. So we have to kind of think about that a little bit, and you will see that come into play when we look at the other way of choosing the strike. But for the moment, let's just consider this one. My trading plan typically is 30 to 35% probability of expiring, which means that that's actually the probability that it would expire in the money by a penny or more, which means what's the probability that I'm going to come down and near the expiration date or on expiration be at about that strike. So for the purposes of our discussion, I'm going to go ahead and pick the 66 strike, and I'm going to set up a calendar just to see what the price is. So we'll have that position in. Now the other way that we could consider selling the strike or buying the calendar, what strike would we sell, is to actually look at the stock itself and ask ourselves, well, where do we think this stock is going to fall? Remember, the ideal climate for this kind of a stock is when volatility is lower and we're looking to take advantage of a move up in volatility. Well, if volatility is low and the stock has made a move up, what are our probabilities of the stock moving back down to a particular level? And if so, what are the probabilities? Where do we think it might land? Okay, so I'm looking at this chart and I'm looking at a couple of things here. I see that the 200-day moving average is heading up towards the $65 level. It's currently at about 63.42. But we can see that the previous level of support is right at about 65, where this bounce just took place. And so if I was to project into the future and ask myself, where do I think this might land on near expiration about 20 days from now, I might say, well, I think that's going to go down to about 65. So I could actually buy a calendar, a put calendar spread in this case, that would be right at about 65. So I would buy the April 65 strike and sell the March 65 strike, and that would set up my calendar, a 1-month calendar. Okay, the other way that we might choose our strike price has to do with how we want to adjust our portfolio. So this is a slightly different perspective, and it has to do with our decision to use a particular calendar to help us hedge or adjust our position in terms of risk. So what I want to do is quickly jump over to the Analyze tab, and let's go ahead and take a look at this position as not a single symbol but a portfolio weighted position against the SPY. Let's show all our positions. Here we have our current positions in place. Let me just delete all the simulated trades in case I have some in here. Reset our parameters. So we're looking at the case. Okay, what I'm looking at here is that in a beta weighted position against the SPY, I'm looking at a position that has a very little upside risk. Profitability currently around 107 on the SPY, but there's an awful lot of downside risk on this position. So I might choose to buy a calendar that is down in the range of where I start seeing some of my potential loss. So we look at this point at 105, 103, 102. What I might decide to do is buy a put calendar on the SPY that would be right around this point right here, let's say 103. So what I could do is go over to the, actually let me go back to the Analyze tab, let's go to the Add Simulated Trades. We've got the SPY up. Let me just look at the 103, need to add a few more strikes. The 103 calendar, I can buy a calendar. Now we'll switch back over to the risk profile. And let's actually look at this position with and without. We see that there's a little bit of an adjustment to this position, certainly. And what I'm going to do is I'm going to add a few more positions. So we see as we add contracts to this position that it tends to have a positive effect in the near term, right? So I can look at adding, let's say, 6 calendars to this position. And now what I've done is that I've lowered my point of serious loss to a point below 102, point below 103, 102.5 or so, right? So our current point is about there. So anything below that, we're probably going to lose roughly the same amount that we were looking at losing before. But what we've done is we've added to our potential loss on the upper side, but not greatly so. In fact, it looks like our projected loss on the upper side is about 207, assuming we allow all those positions to go to expiration. So we can see that without that calendar spread, we have an awful lot of potential loss starting at about 105 and getting much worse as we get to 102, 103. Adding that calendar, we suddenly have a fair amount of downside protection with very little cost on the upper side, as you can see. So that might be a viable way to pick a position is that we pick a calendar spread and we use it to adjust our portfolio and adjust our risk. And what that does for us is that it adds positive theta, gives us a slightly more bearish bias, and protects our portfolio a little more. And for a cost of about, it looks like this calendar spread doesn't cost a whole lot. It's about a 27-cent debit. I see the problem. Let's switch to an April long. And we see that our risk on the upper side goes up even more, but so does our potential profit. And so maybe what we can do is use that to decrease the number of contracts we need to protect that position. And then our risk is balanced out. So we can adjust these positions, and what we're doing in this case is not using a calendar spread to trade on its own, but we're using a calendar spread as a way to hedge or adjust our position and protect us a little more and diversify our position. So it's yet another reason why we would make this trade.